Let me make the introductions. To my side here is Yassir Berbiche, who is Vice President of Treasury Performance and Valuation at Caisse des Dépôts et Placements du Québec. And next to him is Renaud de Jaham, who is Vice President and Treasurer at the Public Sector Pension Investment Board, or as we like to write sometimes, the Pension Fund Manager for the Mounties. So thank you for joining us. So as Dave said, the Canadian pension funds have huge pools of capital available to borrow. They've also been at the forefront of many developments over the years in terms of managing assets. Among the first to develop private equity arms in-house to invest in real assets such as infrastructure and real estate. They've mortgaged their buildings in some cases in order to boost leverage. They've used derivatives. And as Dave said, what you might not know a lot about is their borrowing programs, because they do have started doing that in the last several years. So, Yassir, why don't you tell us a little bit about how unique that is to the Canadian pension fund managers?
Yeah, that's a good question, actually. For us, leverage doesn't mean more risk. If we move away from public equities towards a liquid asset, as you said, be it infra or real estate or credit, at the end of the day, we may end up having less risk. So we prefer owning our own assets, having the hands on the wheels, managing those assets, instead of buying the same type of asset in public markets.
Mm-hmm. And so, and the advantages, where do you see the advantage to issuing debt?
Oh, there are many advantages. So as an asset manager, you have to sell your assets really based on your legislative framework. So some asset managers have the chance also to have really very strong sponsor. And it makes for us, I think we have a quite easy job in order to sell very strong programs when you're AAA rated, when your sponsor is the government of Canada. Mm-hmm. So your sponsor is sovereign. Definitely that it's a source of diversification in terms of leverage. So we can borrow, leverage this in order to borrow really with a very cheap cost of funding, mm-hmm. and hence the return, which is basically the mandate we have from the sponsor.
Right, and perhaps you could just tell us where you are at right now in terms of your borrowing program, Yassir?
Actually, we've been absent from the marketplace for many years. The last deal we did was in 2014. Mm-hmm. And we used to act like a corporation, so coming from time to time, gathering lots of money and disappearing, if I may. Now I would like to be back for good, like necessary, with the necessary signature. We'd like to be frequent issuers. By frequent, we mean at least once a year, benchmark size. We think that our needs will be around 20 billion US equivalent for, I should say, a horizon of 4 years, something like that, 4 or 5 mm-hmm. years. And also tenors should be between 3 to 10s. We would like to help investors building their liquidity curve. Mm-hmm. And for that, you will see us probably next year.
Okay, so you jumped right into your outlook for your borrowing program there. What's made that decision to come back to the market now after being absent for a couple of years?
It's a good question, actually. We've been really successful deploying excess liquidities in less liquid assets, as you mentioned, like introduction, and also we feel that the second reason is the fact that we have a good comparable right now, CDPQ. They've been really active lately, issuing debt in the US market and Euro also. So we think that this comparable is really interesting for us, and that's why we think that mm-hmm. it's a good timing for us to be back.
Okay, so you mentioned perhaps in the 2 to 5 year area. Is that what you're considering?
2 to 10s.
2 to 10s.
Yeah.
So
yeah.
Is there particular markets that you're looking at? Do you want to stay in Canada, or what regions are you looking at?
It depends really on the economy. We think that the first one and to have this signature, it will be should be U.S. Debt, and also we've been really. It's a franchise we'd like to keep in the U.S. Not at any cost, obviously. We were able to access this market in 2009. It wasn't an easy time.
Right.
And if the economics are good, as we think, we will be back.
So it might be the first time in a decade that you would be back in the U.S. market in a lot.
No, the last time was in 2014, actually, for a 10
okay.
years tenure, yeah.
Okay.
Yeah,
All right. And can you give us a hint as to the sort of size you might be looking at?
Benchmark size.
Benchmark, which is, in your case?
We have maturity coming due in November, $1.75 US billion. It will be around this figure.
Something around there.
Yeah.
Okay. So Renaud, how about your program at the moment? Maybe give us a little bit of background of what it's like right now.
Yeah, we have approximately 13 billion of debt outstanding. More or less half of it is with short-term programs. So we have a Canadian promissory note program with an outstanding of more or less 1 billion. U.S. commercial paper with an outstanding in US dollar of 4 billion, which is a strategic, I would say, program for us in order to grow the programs over time. And we have 6 billion of debt outstanding in the domestic market. So basically, I would say that now we're a much more mature type of issuer. We've been in the market last 2 years for 2 to 2.25 billion in the domestic market. I think we have gained a momentum. We definitely, so this year we intend also continuing with that momentum, increase the liquidity of the domestic market with a program of more or less 2 billion. So still in the domestic market. Now, having said that, we have a sequence of events from now and until, I would say, mid-June, more or less, where we intend to launch also a global debt program and eventually to launch the first transaction in the U.S. market.
Okay, so obviously there's a real attraction to expand beyond the domestic border then.
Well, for us, the strategy is to broaden the programs and definitely broaden the investor base. We think we have a very good product to offer. We understand that investors are looking for high-quality products, but also for liquidity and stability. So since PSP, we will grow, I would say we will double in assets under management for the next 12 years or so. So the programs will probably double also. And definitely, so we have an attractive product with an attractive yield, and we will bring liquidity to the markets. And the importance of managing those markets is really to broaden the investor base. Right. In order to do this, you need you need your Canadian investors, and you need also international investors.
So can you give us a hint as well what type of size you might be looking for in terms of that U.S.
Yes, and even the Canadian market, we're always saying benchmark size. The reality for us is that for us, benchmark size means 1 billion, definitely. Right. In the U.S. market, it will be benchmark size, and it's really not likely that it will be much more than 1 billion because the programs are not that big at this stage. Right. 13 billion. When we're talking about a 1 billion issuance in the US, it means almost 1.3 billion for us.
For Canadian.
So we have to make sure that we right-size the transactions in order to be frequently in the market. And I think this is something that the investors are looking for. It's issuers that keeps a presence in the market.
So you're really ramping up there. So you said a doubling in your asset base, which will take you to about
300 billion.
So you
So
have
call it 25, between 25 and 30 billion in terms of recourse leverage. Yeah.
Right. And you both, I understand, you have a caps in terms of how much you would borrow against your assets. So can you tell us where you're at now?
Actually, it's the limit is 10%.
10%.
It comes from the BRS to keep the AAA. They review the methodology. They will be issuing the final version of it. It was like mechanical, so the moment you breach the 10%, it's automatic downgrade. They will remove it, this mechanical thing to do that. But the 10% for us is a lot of money, so we are really comfortable with this limit right now, and we are not, I don't foresee us
Where are you at about now?
4.6% is really,
okay, so you have some room.
It's really low by any standard, and the lowest in Canada, actually. So.
Renaud?
Yeah, we have the same limit for the same reasons.
Right.
And I would say that it fits perfectly also our mandate, because we have a mandate to achieve a certain return for a long-term return for the government. We understand that leveraging the balance sheet we have is something good to enhance the return. But at some point, you have also to deserve your AAA rating, to understand your mandate. So 10% limit is perfect for our mandate. And we have set up a platform where we will cruise at about 8 to 8.5% all the time. So basically, you can expect the leverage outstanding, debt outstanding, to grow really at the same pace of PSP assets under management with very flexible programs. This is one of the reasons why we use the short-term paper, is that it's extremely flexible for us to reduce the leverage if needed in order to have that sustainable 8 to 8.5% leverage ratio.
So tell us how much you estimate that you can juice your returns by adding this kind of leverage onto your balance sheet. Yes, sir?
It depends how you deploy it. It's hard to come up with a precise figure. For instance, if we switch part of the mortgages we have on buildings by a portion of AAA, for us is pillar of value creation. Spread could be lower by 200 basis points for this type of leverage. But it's really hard to have a precise.
Do you have an estimate?
Well, again, it depends how you see the how you see this question. First, if it's a matter of leveraging the balance sheet to lever private markets such as real estate and infrastructure, it's much more cost efficient for us doing it internally. Having said that, you have to look at a spread of AAA against a BBB or a single A minus or so. So this is the savings. If you look at leveraging the balance sheet and increasing the beta exposure, definitely that you can figure out that PSP we've borrowed at less than 2% last 5 years, even less than 1% sometime. And we have performed pretty well. So it means that we have really levered the balance sheet and provided returns of 10 to 12%. So it means a lot of enhancement in terms of return.
So we heard earlier about the green bond boom. Is this something that you see in your future, Yassir?
We would never say no, but for us, the priority is really to earn this SSA signature type of doing business, and we will have to walk the talk before talking about green. We will see down, maybe in 3-4 years, something like that, but not right now. It's not in the
Renaud?
For us, we have to stay focused on what we are doing, not spread out. I think it's a good idea eventually. Now, today we're working really hard on in order to launch the global debt program.
Right.
It involves a lot of things for PSP because it involved the fact that we will increase transparency, which is a really good thing. We will, in order to issue frequently in the global market, it requires that we disclose financial information on a semi-annual basis, which is not the case for us. So it's a big deal for us shifting from annual disclosure to semi-annual disclosure. So we're focusing more on this, delivering this, and we'll talk about green bond later. Maybe you will have to invite me again to talk about that.
So what are the conditions that you're looking for in order to launch your next big bond in the U.S.?
Best pricing.
I mean,
obviously,
rates are
one
only
of
going
them.
up.
Actually, we know that we have something to renew, so it will be market conditions driven transaction, and it has to be after the launch of our financial results, so somewhere in the spring, and we are interest rate agnostic because we will issue to deploy. So if we pay more, we will ask for better return. We look at this like a spread. You know, it's not in absolute terms, but in relative terms.
Right. And Renaud, is it a perfect market for you out there for an issuance?
Well, perfect market. I would say that similar to Yassir, I would say that not that we are rate agnostic, but definitely we have to arbitrage the cost of funding and the expected return from leveraging the balance sheet. I mean, this is key to us, though. So. For me, markets are really good at this stage because the sky is blue. Investors are looking for products, and I think that we have an easy job to do when I look at the situation of our debt programs being in a federal sub-index. And with a very attractive pricing over Government of Canada, it's I think market conditions now are very favorable for us.
Yeah. And what kind of sort of customers are you looking for? Who are your investors? What areas geographically are you
I would say it's really important the type of investors and the diversification in terms of type and of regions also. Type, so we're talking about institutional investors, we're talking about bank treasuries, money funds, globally central banks. We like diversification between Asia. There's a lot of insurers companies that are looking for high-quality products such as us. So it's really important for us to diversify the types and the geographies. So we absolutely we are delighted to see Asian investors, central bankers, etc., coming up in our deal. This is really great to see.
Okay. And so, Yassir, I mean, it sounds like there isn't any downside risk to this sort of program. What sort of what issues are you looking at in terms of risk for borrowing?
From the investor's perspective?
No, from your perspective.
My goodness, it's an interesting question actually. For us, we never leverage for leveraging. We have to deploy. So it will be really opportunity dependent. As I said, we are rate agnostic, but not spread agnostic. So it has to be a good to enhance the yield, and it has to be really cost efficient. So we have a group dedicated to balance the risk of the whole organization. It's a matter of portfolio construction. Part of it will be somewhere, a little bit of leverage. So that's the rationale behind our strategy. And we've been roadshow since last April, 4 months. We did a lot of meetings in Europe, Asia. 2 weeks ago, we were in California, and we are now with you today just to be sure that we enlarge the investor base.
And Renaud, do you think your Mounties who are receiving pensions should be a little bit worried about the debt that they're taking on?
I don't think so. They have to see the benefits of it. So definitely, if you look at the structure we have in place, it's really safe product because the fund we manage is extremely liquid. So for the investor, it's a good thing because they don't have to worry about the liquidity and the likelihood that we will pay their coupons and the maturities and so on. Very conservative type of leverage. As of last year, we were about more than 160 billion of assets with 12 billion to support 12 billion of liquidity. So I mean, I don't think there's really nothing to worry about. Again, when your sponsor is a sovereign AAA credit, I mean, there's not much to worry about. So again, I think there are a lot of benefits with regards to leverage. It's a matter of managing a very decent size.
Great.
Let's say.
Okay, I think we're just about out of time, so we'll look forward to you in the market and writing about stories about your issuance coming forward. Thank you very much for joining us.
Thank you, Jacqueline.